how do we do a margin-based ROI? And the problem is, what type of margin? It turns out that there are 10 or 12 different types of margins that will be familiar to people in finance. The two most commonly used and talked about is net margin and gross margin, but there are many, many other kinds of margins that finance is going to be aware of. So net margin is, at a very, very high level, how much income did the business make after they paid all their bills, versus how much revenue they generated. So, in most businesses, that net margin is down and around 15%, 12, 15% is relatively small. Which means that they're spending, 80, 85, 90% of the revenue they bring in is spent on running the business, making the product, selling the product, delivering the product, and then all the overhead of running the business. But but a more important number is what's called gross margin. And so this is essentially revenue minus COGS divided by revenue. So COGS is an acronym. It stands for cost of goods sold. And so this really encompasses everything that a business has to spend to be able to deliver one more unit of product to a customer. So if you're manufacturing Toyotas, it's the cost of all of the parts that you had to buy and bring into the factory to assemble into a Toyota, all the labor it took to assemble those parts, and then all of the expenses that you incur in getting that car from the factory to the showroom and into the hands of a buyer. So it's all of the things associated with making and delivering the product to a paying customer. Um, uh, so there's another type of margin, and this is the one we're going to focus on. It's called contribution margin. So contribution margin is gross margin minus the cost of selling the product. So we have essentially two costs here. We have, it costs us something to produce one more unit of the product and get it delivered. But then it also costs us something to get that customer to be able to close that customer that we're going to deliver the product to. And so these are both real costs that come off of revenue. So, and that cost of acquiring a customer is essentially the cost of the marketing plus the cost of the sales. Um, and so, what's left over after this, um, so this is essentially, so contribution margin is essentially what's left over after making the product and getting the product sold. And these are real costs that businesses have to write checks for and send out the door, and they only get to keep what's left over. So the important thing about contribution margin is that it's what's called the marginal cost of delivering the next unit of sale, meaning um, we're not looking at what did it cost to build the factory. We're not looking at what did it cost to, how much did we spend on the development team to produce the SaaS product. So these are sort of historical sunk costs that we're trying, ultimately we need to recover those costs as a business. But the first step in recovering those costs is to make sure that we sell it for more than the direct cost of making it and selling it. If we're going to sell it for $100, we need to make sure that it costs something less than $100 to both make it and to sell it and deliver it to the customer. And so even businesses that are, say, early stage, fast growing businesses that are losing money, where they're relying on, say, outside venture capital investment to be able to cover their expenses, there's still the expectation that contribution margin will be positive. And you see this, for instance, with Amazon and their history. So Amazon did not start booking profits for almost 20 years. And they spent that time basically making a lot of money off of every individual unit they sold. So their contribution margin was very positive on each individual item sold through Amazon. But they were taking those profits and pouring it back into building more warehouses, buying more inventory, and buying more trucks and airplanes to deliver it. And so, they were basically financing their capital expansion over their first 20 years because they had really strong contribution margin for each individual item sold. And so that's typically what you see in businesses is that you focus on not revenue, not net margin, which can both be, net margin can be way negative. What you focus on is contribution margin. So now if we go a little bit deeper, contribution margin is still not marketing's return. It's not what marketing is delivering to the business. Marketing's only delivering a part of that. So some fraction of that revenue would still have come in even if marketing did nothing, even if marketing didn't exist. And again, you often see early stage startups that will invest in a sales team well ahead of bringing in a marketing team. And in those companies, they were still making money, maybe not very efficiently, but they were still bringing in revenue long before the first salesperson was ever hired. And so sales is directly producing some fraction of that revenue, but then there's some additional fraction of revenue that exists solely because marketing is in place and doing their job. The other thing that's important here is this is not about marketing sourced revenue. Marketing sourced revenue is a very bad idea. And the reason why is that just because marketing solely sourced that lead doesn't mean that lead instantly materialized into a pile of cash. That lead still has to go through a lengthy and expensive sales process. And so when marketing does their presentation to the board or to finance, and they say, we had X number of dollars of marketing source revenue. When they leave the room and the salespeople come in and do their presentation, the salespeople will say, that's BS because every one of those deals, we sold it. Um,
Exactly. Yeah.
and that's a convincing argument that not only completely undermines the whole concept of marketing source revenue, but undermines the entire credibility of the marketing team. And uh, because the reality is that in a sales-based organization, again, if you're not a direct-to-consumer, fast fashion e-commerce site, if you're in something like a typical B2B enterprise SaaS company, um, every single dollar of revenue flowed through the hands of a salesperson. And that salesperson typically put in weeks or months of expensive effort that the company is acutely aware of having paid for before that revenue materialized. And so there's really no concept of marketing sourced revenue um, other than as a mechanism to kind of destroy your credibility with finance and senior leadership in the company. Um, so how do we actually get at this contribution margin? Um, and there's a couple of ways of doing it. And what I want to talk about is kind of the simpler of the two ways. So here, you really kind of just need four numbers. You need your total revenue, what your COGS are. So, what were the direct cost to make and deliver the product? For a SaaS company, this is not going to be the cost of this development team, but it's going to be related to things like server and bandwidth cost. A lot of the costs are going to be related to provisioning and early stage onboarding and support. So these are all part of what it takes to deliver that type of product. If you're a manufacturer, it will be what's the cost of the materials and labor to produce, one more unit of product, and then what's it cost to put that on a truck and get it delivered to an actual customer. Um, but um, but there will be some sort of a COGS figure. For manufacturing, that COGS can often be 40 to 60% of revenue. For a SaaS company, it's can often be as little as 10 or 15% of the revenue, but it's not zero. And then what did the company spend on sales and what did the company spend on marketing? And so basically contribution margin is going to be the gross margin minus the cost to get the customer. So essentially, what did it cost us to make and deliver the product, and what did it cost us to get someone to deliver the product to? And so an example of this would be um, if we made 40 million in gross revenue for the quarter, we had 10 million in COGS. sales, we spent 10 million for sales cost and 5 million for marketing cost. So at a very high level, that contribution margin is going to be the 40 million in revenue minus the 10 million, minus the 10 million from sales cost, minus the 5 million. So that 40 million in revenue is going to become 15 million. And this is why the traditional way of calculating marketing ROI massively, grossly overstates what the ROI is, because you're reporting ROI against 40 million, but the company only gets to keep 15 of that. And the deal is that they know, people in finance know this. They're not being fooled. They know that these ROI numbers that marketing is reporting are completely fantasy numbers. Um, so um, let's see, there was a question about, so where's the cost of the dev team?
Yeah, where's dev team fall?
So
Dev falls under COGS in a sense, does it not?
no, no.
Oh, it's
So,
labor.
so typically, here's an easier way to visualize how you account for the dev team. The dev team for a software product is equivalent to the factory for a physical product. Um, because they're the ones that, the dev team is the ones that are actually making the exact thing that gets delivered to a customer and used. In the same way that a factory is making the widgets that are, they're taking parts in the door, they're adding labor to it, and then they're using their machine tools to then, fabricate these parts into a final product that gets delivered to the customer. So the factory is considered a capital expense. So whatever it costs you to build that factory, is a long-term fixed sunk investment. So typically you've already spent the money on the factory before the first unit comes off the floor. In the same way that you've already spent huge amounts of money on that development team before the first usable version of the product is ever able to be logged into. Um, so typically what you do is you want to separate, from an accounting standpoint, you separate out these kind of long-term sunk costs, um, that that uh, that you had to make an investment in order to have something to sell. Separate that out from your short-term variable cost. So, if you didn't make that investment to create the product, you would have nothing to sell. But once you've made that investment, then there's going to be some cost to actually deliver it to the customer and to actually acquire the customer through sales and marketing. And so, um, uh, so basically that investment in software development or that investment in building the factory is a capex that then gets either amortized or depreciated over a period of time. So in other words, uh, you know, at some level in the accounting, they are applying some cost, some prior expense toward building the product to every individual product that goes out the door. Um, but from our standpoint, in terms of because marketing and sales are purely operating expenses, they're not capital expenses, and so that's why we can focus just on contribution margin. What's that incremental cost of getting one more unit of the product delivered to a paying customer. And so, um, um, anyway, so this is why it's treated a bit differently. The other thing is there's also a lot of additional overhead. So there are other operating expenses, OpExes, that the business incurs that are sort of spread out across everything. That's a less, that would not be part of contribution margin. So for instance, the finance team, the accounting team, HR, the facilities, the office that you're in and what it costs to pay the rent on the office. These are all overhead expenses that are assumed to be kind of fixed expenses for the business as a whole. Um, and you're allocating portions of those expenses to each new, each new unit of sales revenue. But it's not, these are not expenses that would go up or down if you sold more or less. And so the kind of the key question is, if we suddenly sold nothing this month, um, what would our expenses be if we sold twice as much this month? How would our expenses change? Um, so if we, let go of the sales team, let go of the marketing team, just went to zero activity on all of those, um, um, obviously revenue would go down, but um, you know, but but y- but these aspects of expenses for the business are considered variable costs, meaning that they're going to go up and down as revenue goes up and down in a way that the size of HR, for instance, isn't going to go up or down each month based on whether or not revenue went up or down. Long term, as the business grows, HR will grow with essentially relative to the size of the business as a whole, but it doesn't fluctuate up and down from month to month.